Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. Today, what I'd like to talk about is comparing two different people that have two different credit scenarios. Our first person has a great credit score. Let's say they're in the 700s. They're able to qualify for the going interest rate on a 30-year fixed rate mortgage. Let's say that's at 6.875. And this person just went out and got a new car. They financed $35,000, and let's say that interest rate over 5 years on the term is at 7.5% interest. And our second person, well, they have a lower credit score. Let's say they're in the lower 600s. I'm going to suggest that they get the same exact mortgage, $400,000, but they're paying 7.5% on that interest rate. And they also got a new car loan at $35,000 over 5 years, but because of that lower credit score, they're actually paying 14%. And if your initial reaction was like, holy moly, 14%, that's crazy, nobody pays that. Listen, if you have less than a good credit score, you are in the teens all day long for an interest rate on a used car. I just did a loan application a few weeks ago for somebody who wound up getting financing on a new used car. She has a score in the low 600s and she's paying 17% interest. And I know this because on her credit report, it reflects the length of time for financing and the monthly payment. So for me, it was really easy to solve for X, which in this case was the interest rate. So I'm trying to be very generous in this example and just using 14%. So I'm talking interest rates in terms, but what does this result in for monthly payments? Well, person A has a mortgage, principal and interest of $2,627.72. Person B has $2,796.86. The difference is just over $169 a month. And for you people who love exact numbers, it's $169 with 14 cents. Now, what about that car loan? Every month for 5 years, person A is going to pay just over $701 a month, and person B is going to pay over $814. So the difference is $113.06. So this may not sound like a wild and large number, but here's what I want to share with you. During that mortgage, the extra cost in the first 5 years of having that loan is over $10,000 in higher interest charges because of their credit score being lower than the other person, and all other factors are the same. Well, what about that car loan being fully repaid after 5 years? Do you remember how it started off at $35,000? Yeah, person A paid just over $42,000 in the repayment plus interest, and person B, they paid just shy of $49,000 to repay a $35,000 loan. So in addition to, almost $14,000 worth of interest that they paid on the car note, it cost them an extra $6,783 in interest. So person B, after just 5 years, paid $16,932 more just in interest. Friends, that's just about $17,000 more. Why? Because of credit score. So here's what I want you to take away from this episode today. Credit isn't just a score. It's a cost multiplier. Let me pause now and ask you to think about this. If I handed you $16,932 in cash right now, could you find a good use for it? Of course you could. I bet there's 10 things that hit your mind of what you could do to have fun and be productive with nearly $17,000. And it's unfortunate because we don't think in terms like this. So better credit equals a lower risk to the lenders, which equals a better interest rate, which equals less wasted money. This could be money that goes towards your saving goals, towards buying your first home, paying off other debt, going on the vacation of a lifetime, paying for your kids to go to college, starting that business. investing it so it can compound and multiply over time. So even if your score isn't perfect right now, every point you improve gets you closer to saving real money. If you're tired of throwing money away on interest, create a plan today on how you're going to improve your credit situation. So to round this episode out, and just in case you like a really solid conclusion, let's compare that 30-year mortgage of $400,000 loan amount. Remember we had a 6.875 interest rate versus a 7.5% interest rate? Well, let's say that you didn't pay a dime extra or a day early on that 30-year loan. That $400,000 loan amount, once it's repaid with interest at 6.875, will result in a repayment amount of $545,977. And for that 7.5% interest rate, friends, over $606,000. That $400,000 loan became over $606,000 in repayment. So the difference between those two over time is $60,000. Now, I realize that's over 30 years, but what I want to show you is that interest on your mortgage, that interest on your car, that interest on your credit cards, student loans, personal loans, those all compound, and it could cost you hundreds of thousands of dollars more over your lifetime because of a lower credit score. So I invite you, dive into the other episodes that I've provided that talk about charge-offs and collections and expediting your payoffs, how to reduce interest by paying a little early and extra or bi-weekly payments on your installment loans. There are episodes on how to improve your credit score, how to rebuild your credit profile, and even how to build credit without going into debt. If there's a topic I have not yet covered, or you have a question, send me an email at questions@creditchristie.com. You'll find that email address in the show notes, and I'd be happy to help. If you want to learn more about money and how to win with money, check out my book on Amazon called Finish Financially Free. Thanks so much for listening, and until next time, my friends, stay well.
Subscribe now and share with a friend to stay in the loop for new credit content and insider tips to maximize your credit knowledge. And follow Credit Christie on Instagram.